Hello and welcome back. Crypto bouncing nicely after another fairly upsetting sell-off into yesterday. I think it's pretty clear at this point that the market is displaying cycles, and I think those cycles are tightening. So awareness of this gives us something of an edge, and I want to jump into that in just a second. There is also further news from Trump on the tariff situation with China. But first of all, let's just take a look at the Bitcoin market. So priced now at $107,900. Yesterday, we slipped and we lost support once more, coming to a low of $103,500. Once again, as always, that was led by liquidations. You can see in the last 24 hours, $900 million worth of liquidations just a few hours ago. This was showing nearly $1 billion worth of cumulative liquidations, and the majority of that was on the long side of the market, $622 million worth as we slipped through stops. I think probably a lot of stops here at the lows of 107,500. That is pretty much what we saw the day prior to that, with stops going off around this $110,000 region. But this time we also had the anchor of this spot wick here at $107,000. Of course, that wick came in slightly differently depending on which market you're looking at. But what I want to point out here is the cycle that I see, and the cycle that I see repeating itself. This is why I am not yet uber excited about a move to the upside. I don't think we're yet at the point where this thing is going to turn around just yet, outside of broader market catalysts. So as we know, retail traders love to jump in on leverage on both sides of the market, and they tend to do that too late. So we know that this massive drop here, this historic $19 billion liquidation event, was driven by a lot of traders getting long on this move up, not seeing resolution on that. When prices pulled back just a little bit, those positions became liquidated. This was the start of that, this move that we had on the 7th of October. Then we saw green shoots, we saw a nice little bounce, and we saw even more long leverage enter the market, plus already that body of residual long liquidation risk that was built up during this massive move to the upside. And that all came to bear after the Trump tariff threats on China. And we saw this historic drop involving a historic $19 billion worth of cumulative liquidations, right? Then we bounced from that. A lot of people saw this move as a signal that it was over. Okay, we also had some resolution on Trump pulling back on that initial threat. And the leverage stacked up again. And once more, when we didn't see this thing just go straight to the moon, all of those longs got liquidated. They were forced out of those positions. Emotional capitulation, when they leave those trades early, that is selling. Getting stopped out, that is forced selling. Getting liquidated, that is forced selling of the entirety of the margin on that position, of the borrowed money that they used to get into that leverage long. And all of that is forced selling on the market, spiking supply, and the laws of supply and demand dictate the prices must come down when that happens, and they come down very rapidly because a huge amount of capital is being dumped on the market all in one go. Okay, huge amount of supply, I should say, selling, forced selling, going through, and prices come down. Once more, we bounce from that, and people get leverage long again. And I was talking about this in my videos. It's stunning that even after this $19 billion bloodbath, people were still willing to get over leveraged into this. And sure enough, they became liquidated once more. We saw this green candle, okay, a stab into liquidity beneath that $110,000 range. And a lot of people jumped in leverage long on that again. And once more, they became liquidated. Okay, surely it's over now. This must be it. A couple of green candles, more leverage longs, and they got liquidated once more yesterday. So the good news of this is these cycles are tightening, okay? The first was massive. The second happened a little bit slower, and it was a little bit smaller. The second happened a little bit faster, but it was smaller. The third happened a little bit faster still, and it was even smaller, etc., etc. Right now, we can see, sure enough, the cycle is repeating itself. If I move this down to the one-day chart, you can see there is up to $1 billion worth of long liquidation risk down at a price of $95,860. Now, I don't necessarily like to look at the max risk of this because we see this changing in real time. If you caught my video yesterday, we were actually watching this drop happening, and you could see the liquidation in the market shifting as that happens. Because of course, these people don't have to become liquidated. As I said earlier, they can emotionally capitulate. They can get out of those trades, cut their losses sooner than the point at which they actually become liquidated and are forced to sell. But nonetheless, there is still long liquidation risk in the market. People still have the inclination to borrow money and jump in on this. And we're not yet at the point where that spirit is totally quashed. And in my opinion, that is the point at which this is going to start coming around again. Okay, only at the point when there is so much blood in the streets, retail sentiment is so dead in the water, people don't have any money left to leverage into this. People can't borrow money anymore to leverage into this. That is the point at which the big institutions will come in and buy, because they know this stuff too, right? And they know that only at that point is there is nothing more to be gained by waiting for retail to just shoot themselves in the foot again. And you can see sentiment is down today, right? We're at 25 on the fear and greed index. That is down again from yesterday. And once again, these loops that I described, these liquidation loops, cycles, are tightening, and they're happening quicker and quicker and quicker. And it is looking like we're getting to the point where eventually the inevitable is going to happen, where no one has any interest in this anymore. It looks like we're at the end of the market, right? The end of the bull market, and it's time to pack up our bags and wait for a few more years for the bull market to resume. Only at that point will this turn around. And it sounds like I'm talking about that in a sort of spiritual, sentimental sense, but I'm really not. It's just knowledge of the fact that we know big institutions want to get their hands on Bitcoin. Okay, we see that in renewed ETF products. Okay, renewed BlackRock, new BlackRock interest in acquiring crypto. Bitcoin and ETH, etc. We see that in the accumulation wallets. I've spoken about this before, about to surpass 3 million BTC. These are the wallets that buy Bitcoin historically and never sell it. And these people know about this type of leverage risk in the market, this type of liquidation risk in the market. And it is totally in their interest to play into that and to sit it out and to wait until the point where, as I said, retail has completely shot themselves in the foot. Through their own demise, they've caused a situation where they can't hurt themselves anymore, right? They can't hurt themselves with leverage anymore. The point of max pain is the point where it makes sense for big institutions to sweep in. And once again, because of the way this liquidation map is playing out, I don't think that those cycles are done yet. Although it does look like these cycles are tightening and we're getting closer to that point where retail is just going to run out of steam. And then, of course, we've got the opportunity to get into some of these short liquidations, right? So there are up to $5 billion worth of shorts waiting to be liquidated, up at prices of just $120,500. We were at those prices not so long ago. May I remind you, we were breaking all-time highs just on the 6th of October. If you look back at this on a longer time frame as well, and I'm using this as an example because the magnitude and the speed of the selling, the aggressiveness of that bear trend is similar to where we are right now. So massive crash, spike up to the upside, green shoots, massive crash again. We challenged the same lows, range for a little bit, challenge those once more, and then the long side starts to take over, right? The buys come in and we continue to make new all-time highs. Look back in 2021, similar story. Okay, massive aggressive sell-off, immediate bounce, and then massive sell-off again. And we challenged the initial wick a couple of times before eventually, finally, the market turns around. Imagine how bad the market would have looked at this point, right? If you can't see the rest of the chart. Back on the 19th of July, 2021, it genuinely looked like it was all over. It's not supposed to feel good buying into fear. That is why you're at an advantage, because you're doing something that the rest of the market, the rest of the retail market isn't doing, but the smart money, the big money is doing. And that is why we buy into fear. And that's why I'm accumulating spot right now. And it's why I'm going to continue to do so, even if this move continues down from here, which I suspect is very likely. I am still in my leverage long position here. You can see we are down $6,369. I haven't added to that just yet. I've increased the leverage to 20x just to give me a little bit more wiggle room to the downside, but I will continue adding into this position with the caveat that I'm going to be managing risk so that I don't end up like one of these near $1 billion worth of liquidations we saw over the last 24 hours. We also saw more resolution within the last few hours on the Trump tariff situation. We saw Trump tacoing again. Trump always chickens out. Trump says 100% tariffs on China not sustainable, still plans to meet Z. So he's just further reeling back those threats on China that was the spark that set into motion this massive $19 billion crash and liquidation event. US President Donald Trump said his proposed 100% tariff on goods from China would not be sustainable. but blamed Beijing for the latest impasse on trade talks that began with Chinese authorities tightening control over rare earth exports. Asked whether such a tariff was sustainable and what that might do to the US economy, Trump replied, "It is not sustainable, but that's what the number is." And you can see S&P reacted to that as well. We are up nearly 3% from the lows from that initial crash. And just in the last few hours on that news, we have rallied as well. So there we go. The macro stage is set, but I don't think we're out of the woods just yet, because we seem to be maintaining this cycle where retail jumps in on leverage at the smallest sign of green shoots. But I do think that cycle, or those cycles, are getting smaller and smaller and smaller, and we are reaching that inflection point where it makes sense for the big money to come in. And right at that point, when that does happen, that is going to catch a lot of shorts off guard, and we could see some very spicy price action to the upside. As always, that is just what I'm looking at, shared with you purely for entertainment purposes. Nothing I say should be considered financial advice. Thank you so much for watching. Catch you in the next one. Bye.